Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katsimatidis, Kilroy Metal Products, Marcus and Millichap, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.
Hello, my name is Michael Stoller. You know, it's a tough time out there. It's a tough credit market. It's difficult. So where are people getting money? How are they financing deals? Who's doing it? So I've assembled 4 individuals who really know that market and who are providing that need, that source for people. My guests today are Fred Gould, Chairman of the Board of BRT Realty Trust, David McLean, Principal at Palisades Financial, Josh Zagan, Co-founder and Managing Partner of Madison Realty Capital, and last but not least, coming in from California to be here with us, Maria Stamolis, Senior Director of Canyon Capital. So since you graced us today, by coming to this, tell us what you're trying to do. What are you doing? I know you have an equity fund, but you are lending money. All these individuals are lending money, but what are you doing in the tri-state area?
We are still lending money. We are looking at bridge and mezzanine facilities, but we're also looking at replacement senior construction loans. So
who will you lend to? I mean, what type of people? I mean, how do people come to you? How do they know who they should deal, who you are?
Well, I think, you know, we've been...
the Johnson we know, that's Magic Johnson, but how do they know about you?
Well, interestingly, Canyon Capital was around before the
that.
Canyon Johnson Urban Fund. We've been in business for 18 years, a private equity firm, and we've done business and repeat business with private clients, and we also have institutional investors in our fund that also recommend us to their clients.
So let's look. I mean, BRT is a public company. All of the other companies here are not public, but you all get your funds from institutional investors, right. Also high net worth individuals, a variety of situations. I mean, David, you know, I wrote an article about something that you did and something that Fred's group did recently. You did a loan on a condominium in Jersey City.
That's right.
Let's talk about that.
Okay. It was a loan on a project where 2/3 of the units had been sold, so the construction lender had been paid off. Mezzanine loan was coming due, and that lender could not extend the loan. So we came into that transaction. The borrower only had a couple weeks before the mezzanine loan expired, but in addition, they had over 30 trades that were owed about $9.5 million from cost overruns and from some contracts still to be completed. So it was it's a tricky deal in that it wasn't. We put a first mortgage on the unsold units, but we also then provided $9.5 million and helped settle the remaining 30 trades out. And believe me, for a lot of these people,
But if you didn't provide the money to the contractors, there would have been mechanics liens on the deal, and he couldn't have been able to sell the units.
that's right, the remaining units he couldn't have sold.
Remaining, right.
But those people, and a lot of them were small vendors, would have had to have slugged their way through the mechanic lien process and try to get paid.
So for my audience, why don't you tell us what you charge for this
Well, for the
facilitation?
okay, for the headache involved with that, and believe me, this project, every day we are working this project to get remaining items completed, to get the contracts closed. We got 3 points and 19% rate. Now, if the deal had been cleaner, we would have charged a lower rate, but we think the rate is appropriate for the risk involved and for all of our effort.
Now, Fred, what if, I mean, BRT has been publicly held for, what, 30 years?
Yeah.
So what type of deals do you see today, and what type of deals, because you know, I don't want to say something, 30 years is a little closer than Josh's age, you know, Maria, you know, we don't want to say, but we've seen the experience, and we see cycles. How do you look at the deals today and the cycles that we're in, and what type of deals, you know, when you go to loan committee at BRT, what are you looking at?
We primarily deal on a risk-reward ratio basis. We like to take a certain risk for a certain reward, and we won't take a risk if the reward isn't satisfactory to that particular risk, and they're all different. Years ago, we had a similar situation. You remember, you're old enough to remember the co-op business in New York. It was a thriving business. We were one of the early people to loan money to co-op converters in New York. Thank God the banks then decided it was a good business, and in 1988 or something, they decided to make loans to co-op converters, so they paid us off. So we didn't have very many problems in the co-op field because the banks had them by paying us off. Right now, the condo business is quite similar. The condo business, which was thriving, we made a lot of condo loans to developers or buyers who bought rentals for conversion. It fell off the ground. It just stopped on a dime. There are places you cannot sell any longer for a number of reasons. Number one, there's been, let's say, a buyer's strike, number one. And number two, there's been a financier strike. So even if the guy wants to buy it, he has difficulty in financing it. So what's happened is similar to the deal that David spoke about. People are coming to us and saying, look, here's the last job that we did, for example. The lender, the first mortgage lender on the construction loan, wants to go home. Frankly, this particular lender had to go home. He didn't have a choice. He needed the money desperately. He sold 40% of the job, completely finished, lovely units. He was selling it like $900 a foot, sold 35, 40%, not enough to get the lender out. Lender wants his money back. He said, okay, I've got to rent them because I can't sell them. Not that I'm not desirous of selling, I cannot. So the lender said, you cannot, period. And we'll let you rent them. So we had to get the lender out. He comes to us. We did quite a similar situation. David, we loaned him X dollars against the unsold condominiums.
And we know what he charged. What was your charge?
We don't charge as much as they. We hope that, well, let's put it this way. We think we take a lesser risk for a lesser reward. Hopefully we're right. We'll soon find out.
But what about, you know, there are developers who who may have gone to contract for land, right, Josh, or something like that. Well, what you know, you come, and the hardest thing in this world today is to figure out what values are. I mean, I sat down with Josh's partner a couple weeks ago, and he said, I did a loan, but what's the value tomorrow? I said, Brian, tomorrow, the day after you closed on the loan may be worth 20% less, the value. I mean, because we really don't know what the true value is. So how you know, it's like a vacuum, because we don't have it's not a stable market. How do we look at this? I mean, you know, I realize you have a lot of things. You grew up in Brooklyn, and you know this market a little bit, but you know, you're in California. You know, Fred is in Great Neck, the headquarters. David's in Jersey, and you're on 3rd Avenue. How do you look at the market, and how do you make the judgment? I mean, is it the old 3 credits, you know?
If you're trying to make a loan today based upon the values you can sell it for today, you can't make a loan.
Right.
Period. You just cannot make it. You have to say that I'm willing to eat this product for sale in X number of months and hopefully try to make a deal with a borrower who can pay you the interest for that interval.
And
you
it's
better be
time.
prepared to eat it.
Yeah.
It's time.
But my question, I had a class at NYU today, and I had basically these equity funds like you are, and one of them I said, you know, you're charging a first mortgage. They were doing a first mortgage at a very high price in the meatpacking district.
What's high?
What's high? It was basically 21% effectively
first.
for a first mortgage. And I said, aren't
sound
you
like a
really?
pussycat.
I said, aren't you really lending at this price to own it? They said yes, because we understand. We took care of the Apple Store. We know the market. We know how to develop. We know how to run a retail site. So in case we own it, we can handle it.
But I think that's the business all of us are in. We're not going into it with that intention, but we're prepared to do it if we have to.
But one of the comments that was made this morning was, you know, there's still litigation. You know, you don't get it. You don't
Not
get the keys. You don't
necessarily.
get the keys.
Not necessarily.
I said that to them, but they disagree.
No.
Litigation is a part of the business. If
That's
you don't
right.
anticipate litigation, if you're fearful of litigation, if you're fearful of bankruptcy, you ought not be in this business.
That's right.
And then you price that into your transaction.
Right.
So what are you doing these days, Mr. Z?
We're seeing a lot of transactions where owners are trying to buy back their debt from the bank, and they're willing to come in with more equity, and we're financing first mortgage in those positions. So we're seeing a lot of those kind of transactions, and they're buying at deep discounts. And for an owner, that's
Are you really seeing banks giving the discounts yet?
yeah,
It's
anywhere-
fine. I would
yeah.
say, the last 2 months, you've really seen that actually happening versus it being talked about.
But
That's right.
After Lehman
but
Brothers
I mean,
collapse in
I'd
particular.
say that from my conversations, with the exception maybe you, Maria, I don't think Fred or David or Josh really want to own these properties. If they have to, they'll own it. But that's not really the mantra of the business. That's
But
not,
we go in and underwrite what yield we
Right.
would own it at, and what
Exactly.
kind of return on debt we would own that
Right.
at. So.
And on our loan platform, that's a loan platform. But our equity platform is separate and distinct from that. But we have the capability in house as a result of doing both, to do both if we have to.
And we have a
And
loan,
we are very similar.
Michael, right now on a property that we tried to buy years ago, and we were outbid, and then property subsequently turned, and this other group came in and took a loan from us. Now they're in default, and we're pursuing foreclosure on that. And when the borrower made the comment, well, you don't want to own this, I said, we actually bid on this property 4 years ago, so yes, we're prepared to own it.
Right.
So besides the condos, which I hear, needless to say, there's a lot of condo loans, would you look at a land deal today? Because at one time, I know Jeff.
The only time we do land deals is because, and we're restricted in our land deals because we are public, and B, we have a bank line. So our ability to borrow against our land deals is completely different than our ability to borrow against our property deals.
Right.
So we're restricted in lending on loan. The good thing about dirt is that it doesn't eat very much if you have to take it over. So if you're making a loan at an FAR of $100 a foot, and you're comfortable to be worth more than $200 a foot in 3 or 4 years, it's a good loan. You don't want a real big building that's empty. You want a piece of dirt that's empty. It's much cheaper to carry.
Or a functionally obsolete building
Yeah.
that can generate some income, pay
Right.
for the
But the-
taxes in between.
Two weeks ago, I did a show with the hotel industry, and a number of these people were saying that, first of all, the hotel market is getting hurt, even in New York City. It was marathon weekend, and John Tisch said to me that first time in record history that they had vacancies in the hotel. There are very few new conventions being built, coming into the city. There's a lot of difficulties. What about the hospitality industry? What if somebody came to you today and said, I want you to provide financing for the construction of a hotel, or or even financing on a hotel? What would you say in this market? I know you do it in other markets.
I think that any ground-up construction at this point is something that we would take a very, very careful look at, and it isn't high on our list of opportunities right now.
What it comes
whether
down,
it's hospitality or
yeah,
anything
what it comes
else.
down to is you don't have to take construction
Right.
risk basically today. There are enough opportunities. We're seeing enough income producing assets to finance that you don't have to take on that risk. And in a time when lending was really, really hot and everyone was lending, there was less risk associated because there was always a takeout.
Right.
You know, you were on a number of my panels, both David and you and Jeff and other people, Maria, and you were saying to me, which I think is good for my audience, is that you're seeing deals today that you would have never seen before.
That's right.
That's right.
Explain to my audience what do you mean by that?
Well, we're seeing owners with liquidity, with properties unlevered that would never be coming to us because they had many alternatives just a year or 2 years ago.
For cheap money.
For cheap money, for multiple lenders lending mezzanine money, lending first mortgage money, and that just doesn't exist today, given that balance sheets of banks are just packed with loans and there's
And
no
they're not
liquidity.
lending.
Well,
Yeah,
you're
they're not
getting-
They're
lending.
not lending.
Also, we used to operate in that segment of mezzanine loans or second mortgage loans to fill that cap stack, and now we're getting primarily first mortgage
Absolutely.
opportunities from creditworthy borrowers, where in the past, if we had done first mortgage, either the property had a problem or the borrower had a problem, which is why they're
That's
using our
right.
type of money. But we just had a deal come back in our office where the group originally came in looking for second-tier money, and we said, no, we're not putting it out in this marketplace. And now the bank that was going to do this loan has walked away. So the group has come back in. They're looking now for a first mortgage. They've added more equity to the situation, and so we're taking a hard look at it.
You know,
Mike, what's happening now is you're really not lending against distressed property.
Right.
Yeah.
You're really lending against good property
In a distressed
to a
market.
distressed borrower.
Yeah.
And there's a hell of a difference. The reason he's distressed has to do with his inability to get other financing.
Right.
But you don't want to make a loan people use the phrase distressed properties. None of us want to be in distressed properties.
That's right.
now I have a question. You have bank lines. How does the bank lend to you? I mean, do they say you can lend? Do they look at every one of your loans,
No.
or you have an open line based on your
We
ability?
couldn't do business if we had to wait for
No,
them
no,
to-
I agree. But now, what parameter? How much will they lend you on a loan? On average.
I think our it depends upon what it is. On vacant land, the loan is X. On income-producing properties, Y. I think it's about 70%, 65% of our loan.
Now, do you see, because I know Josh is that situation, all of you, do you see banks still interested going back to lend to people like in your business?
I can't answer that. All I can answer
No,
is
I'm
how it
saying
affects
about,
us.
I'm talking about their lines.
Our bank line is X dollars. We have one more year and extension on it. No one's come in and say we won't. We write them a note that money's in the bank.
Yep.
And what about you?
Well, we have a credit facility. It's actually issued by a hedge fund. So our ability to draw on that facility was based on the position of the transaction, the type of transaction. They did come back in and restructure that facility.
Make it a little harder?
Yes. Lower levels in all first mortgages, cash flowing properties, that type of thing. But we have
But you didn't have to get. You don't have to give all your loans to the hedge fund, do you?
No, it's voluntary. Actually, we started last fall paying down our credit facility because we already were concerned as to where the market was going. So we paid off our facility. It still exists, but they did change the parameters that we could use that facility.
And you, Josh?
We were actually very fortunate. Our line of credit extended till 2011 in December of last year. And we have certain parameters. It's a warehouse facility, and it's really, obviously, it's a little more challenging, or it takes more time to pledge loans today, but we still have.
And Maria?
We don't work that way. We fund off of committed capital for either loans or equity.
I will say, Mike, we have a partner in the Jersey City deal, and they had a line that just came up recently, and it did get renewed.
Right. I mean, because I remember what Fred was talking in the late 80s, early 90s, there were a number of hard money specialty lenders whose banks, I remember Bank Leumi was one of them, IDB, a number of the banks, they woke up one day, it wasn't because their portfolios were bad, they just said, we're out of the business, right?
But those weren't lines that had a due date or an extension date.
Right.
They simply, Chase walked away from the business. Chase walked in one day and said, they no longer want this business. But we had some lines with Chase, and they said, when you can, pay us off, and that was all. They didn't say we don't want, we want money on
but
Tuesday.
that was Chase. But the other banks, I do remember specifically, they just said we're out of the business. You know.
And they welched on a commitment, you're saying?
Yeah, no, they just walked around. So now what's your favorite type of asset? Okay, some people, you know, because people do watch the show, and I remember a great story on the last Money Summit that I did. They heard all these specialty lenders, and one person called about 5 of them, and used somebody who I wouldn't have on the show here. Because he was offering financing. He was the one who raised his hand. I do anything. You know, and you saw the deal. You saw the deal. Jeff saw the deal. I don't know if you saw the deal.
He sat next to my love.
Okay, he said that. So what's your most favorite asset that you try to lend on, and least favorite asset today?
I mean, I think we like rentals because we do believe that home ownership is shifting to rentals. And since we prefer urban markets, we believe doubly that that will be the case, and we believe that the rent rates will be stable to strong. We also do like office where you could reposition. And again, urban on that side doesn't necessarily mean that it can't be office, because you can be serving a community by, you know, creating jobs and helping in that regard. So we do hit both parameters with office. I think retail's tough right now. I don't think any of us would disagree on that.
With the exception that I think urban retail is still strong.
You know, it's
urban, local.
Walk down Madison Avenue.
Oh, okay.
Before you make that judgment.
You know, and they say the same thing, truthfully, about Rodeo, you know, when it comes to LA and Beverly Hills, but it's, even if it's true, a needle in a haystack, and, you know, we don't do business that way. So I think as much as we would look at a strong retail center where maybe there is a reposition opportunity.
You mean you wouldn't like having something that you have Circuit City over there as your tenant?
And obviously condos, you know, we would do a similar thing to, you know, what Palfi did, where we'll look at the unsold units, we'll underwrite them a certain way, and we'll lend on those for a period of time so that the takeout as either a rental or a sellout through the next 2 to 3 years is possible. But industrial, we do a little bit of.
Josh?
Not big for us.
Multifamily is our favorite asset class. Fannie and Freddie are still lending. FHA has a program, the 223 program.
So you're saying anything
lending.
where you may be able to see a quicker takeout?
There's a real exit that you can see, and sure.
Dave?
Multifamily, cash flowing type of properties, so like this deal that came back in. One of the things we've seen in our segment is even smaller type transactions. They can still get financing from the local banks. There's an article in the paper today talking about that. So although the banks do the 3 or 5 C's to put the financing out, but you can still underwrite an exit scenario on helping the person move, if it's an office building or industrial, to the point where that bank will come in and take you out. If it's a larger transaction, that's small as like 20 million and below, a larger transaction, you just can't underwrite an exit scenario. On a refinance.
50 and above is almost impossible to see right now.
Let me tell you we won't do, because I'm very, very fearful of New York City office. You're going to see a 20% decline in rents and a 15% increment in expenses, because
you have a 7% increase in the real estate taxes minimum.
So you're going to have a 20% decline in rents from the high, a 15% increment in expenses, and a minimum of a 200 to 300% difference in cap rates. So you're going to see a valuation change in New York City office from high to low of a minimum of 40%. And so lending into that today is, I think, extremely dangerous, because the handwriting is on the wall. What happened in early 90s is happening again, for sure. You can't get 165,000 fewer jobs and not have an equal number of space available.
I mean, just as an aside on that, I was with a broker the other day, and they said they had looked at a property at 729 7th Avenue 2 months ago, and the landlord was asking $51, and the tenant said, I have no desire. So the broker put a bid in, and he said, when you're ready to talk about $31 a foot, I'll have an interest.
That's 40%.
Last Friday,
That's 40%.
last Friday they got a phone call. We're interested in talking at 31%.
Mike, that's 40% difference. If that happens, then the value of the building has gone down,
By 60%.
Yeah.
and that is a scary number.
Yeah.
But, you know, part of the situation, this is an owner who's owned the building a long time as opposed to someone else over there.
I didn't say from his value was going down. I said the value from high to low.
That's right.
So you don't like office buildings, and what else?
We'll do almost anything that's not a specialty. We don't do nursing homes because none of us know how to run a nursing home. That's a business. We don't do things that are a business.
So you won't do a hotel either because it's an operating business.
We've done a couple of hotel loans where someone who's joined with us. I was on the board of a major hotel company for many years, and the former chairman. If they join us, so I know I have an arm who can go.
Who can handle that property over there?
That's the only time we'll do that.
So how long do you think, I mean, this is a good time for everyone sitting here because you have capital, you have the availability, you see it. How long do you think it's going to be, and we just spoke a little bit before tightening of credit gets a little easier? Fred?
I'm not an economist, so I can't answer that question. All I can tell you is that the economy is going to be worse in 6 months or 9 months than it is today. And I don't know the banks, will they get the capitalization? Uncle Sam has made a decision to be a partner in the banking business at a level which you and I wouldn't be a partner. They're giving their money to major banks at a coupon that precludes us from investing in that bank because they're such a better deal. So they're pushing money into the banks in hopes to. I have no idea whether it'll work or not, Mike.
Dave?
Well, right now, you're seeing where the banks' alternatives in buying bonds, for instance, they're getting their 9–10% yields. And in fact, today there was an article talking about the top tier CMBS products trade at 633 basis points.
There's no question. It's better to get an investment in a good bond than to set
But with
before
spreads like
general.
that, that's right.
Cheap credit being pushed in the banks, they're not going to put it out in the commercial real estate market till the end of next year, maybe. Because one of the other problems is no one knows how far these values are going to go down. As Fred's talking about it, it's just. So they don't want to put the money out,
So I think my audience got a pretty good idea that there is capital available. You have to know the good sources, and I'm very happy that I've brought the good sources of people. I'd like to thank Fred Gould, David McLean, Josh Zegan, and Maria Stamolis. See you next week.
Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katzimatidis, Kilroy Metal Products, Marcus and Millichap, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.